Good morning, everyone. Can you please indicate in the chat if you can see my slides and if you can hear me clearly? Thank you so much. I'm just waiting a few minutes for more students to join us and then we'll begin. So let's just give them a few more minutes. Some notices before we begin. Please rename yourself, your student number, and your name. If you go to the participants, click on participants, find your name, and then you'll see 3 dots on the side. Just right-click and click on rename and type in your student number and your name. Your Sage book and training and your assessment is available for you. So you have 3 weeks to complete your multiple choice assessment. And remember, if you want to improve your mark and do it a second time, then you need to also do it within those 3 weeks. If you have any queries relating to Sage, please email Kerry, and her email address is on my screen. You will need your textbook notes on group financial statements in a week's time. Next week, we'll be completing changes in accounting policies, and thereafter you will start group financial statements. So you will need that textbook. You'll be working exclusively from the new textbook, and you'll be making notes in that textbook. So please make sure you have that at hand when you are attending our Zoom lectures. Okay, so the last time we met on Tuesday, we were doing correction of errors. We had covered all 3 types of errors: our prior period errors, our errors that occur in the current period that are immaterial, and prior period that are immaterial. And then we looked at an example 9, which covered a prior period error that was material. And then we moved on to example 11, and we went through the disclosure in example 11. Example 9 and 11 are the same example. So example 9 has the journal entry and workings, and example 11 has the notes, the statement of financial position, and the statement of changes in equity. So what we need to remember is with every example that we've completed in this chapter, as we move through the examples, we get more and more complex. So we've covered example 9, and along with that, we covered the current and deferred tax implications. So today we're going to do an example 10, which is the same as example 9, except that we're now going to focus on the tax effect of having an error. When we've made an error in a prior period that is material, it means our previous financial statements are wrong. So besides correcting our financial statements, we also need to correct our tax disclosure that we've made to the receiver of revenue. We need to inform the tax authorities that our financial statements were published and the prior year figures were incorrect, and we now want to adjust our tax accordingly. So the receiver of revenue is going to give us one of two options. So he's going to say to us, number one, your option is that I will open up your prior year tax assessment and you can make your adjustments in your prior year tax assessment. The second option that you have is when SARS says no, you cannot open up your previous year's tax assessment. I'm not going to go back and open all those previous years of tax assessments. Instead, I want you to accumulate all your adjustments and make the adjustment in your current year. So when you are submitting this year's tax return, make your adjustment for your error that you've made in the past. Make the adjustment in just this one tax return. Now, it's important for us to read our scenario to understand which option we fall into. In the first option, when prior year assessments are reopened, it means that we can process journals to current tax payable and amend the amount that we owe or is due from the receiver of revenue. However, if the receiver of revenue says no, you cannot open your tax assessments, then we need to make all the adjustments in the current year's tax return. That means the journal entries to correct the error for tax purposes, current tax purposes, will only occur in the current year. So it is important for us to understand those two options and how they will affect our journal entries. So the example we're going to do today is example 10, which has the same error that occurred in example 9, but we're going to be given two scenarios. So if you follow with me in your textbooks, please open your textbooks to example 10. And in example 10, you will see that you've got right at the top of example 10, it tells you it's the same information as example 9. So you've got a machine that was purchased in the year 7 and it had been expensed. So instead of capitalizing the machine, this machine had been expensed as a marketing fee. And the value of that machine is 1 million rand. It's considered to be material. It is a material error. And our depreciation is 20% on the diminishing balance method. And we are told that the error does affect our tax calculation. Our tax rate is 30%. And our wear and tear rate on this machine is 20%. So the first thing that students say to me when they are tackling their tutorials is, I don't know where to start. I'm not sure how to tackle this question. Do I do the workings and the notes first? Do I do the journals? Do I do my statement of changes equity? What is it that I do first? How can I manage my time so that I can complete this question in the least amount possible? So the first piece of advice I give students is a stepped process that we're going to follow this morning. So please follow this process and practice this when you are attempting your tutorials for next week. Number one, we need to understand what was the error made. So write down a journal entry of the error that was made. So if you look at my slide, at the bottom of my slide, we've got the journal entry for the error that's been made. We've debited a marketing fee, which is an expense that appears on our statement of comprehensive income. And we've paid for that either via bank or liability for 1 million rand. So that is the error that has occurred. The next thing we have to ask ourselves, so step 2 would be to say, well, instead of debiting my marketing fee, what should I have debited? Can you tell me in the chat, what should we have debited in our journal entry instead of the marketing fee? Well done. I've got equipment, I've got cost with the element asset. Well done, machine. All of you are correct. You could simply say debit, well done, debit, machine or equipment, cost, SOFP, well done. So that is the error that's been made. So step 1, we know what the error that was made. Step 2, we know how to correct the error. Instead of marketing fee, we should have debited our asset account on our statement of financial position. Okay. Now that we know that, we have to process the correcting journal. So in the chat, I want you to tell me, what is the correcting journal then? What do we debit and what do we credit? You've said to me what we should have debited. Now I want you to process the correcting journal entry for this 1 million rand. We're not worrying about tax at the moment. We're only worried about correcting this error that we have. So in the chat, I want you to give me your journal entry. Very good. Are you debit equipment, credit marketing fee? Well done. Well done, Caroline McHale, well done. Tranio, well done. We're going to credit our marketing fee and we're going to debit our machine. So we've done step 1 and step 2 then of correcting our error. Okay, now we have to ask ourselves, how is it going to, so the third step is, how is this going to impact my current tax? And step 4 is going to be, how does this affect deferred tax? Okay, so step 3 is, how does this affect current tax? And step 4 is, how does this affect deferred tax? Okay, so now we've got a 4-step process. Number 1, find out the error made. Number 2, correct the error. Number 3, what is the current tax effect? Number 4, what is the deferred tax effect? Now that we have that, we can process our journal entries to correct this error. Now, whenever we process a journal entry to score marks, we need to remember that we need to provide a date, we need to provide elements, and we need to provide a narration as well. So my first question to you will be, if we had to correct this error, what is going to be the date that we use to correct this journal that I have up on my slide? All of you have provided me with the journal entry. On what date are we going to process that journal entry? Well done, Sabiso, Kamendri, Yoshlin, well done. Zinchle, have a rethink. Okay, the correct answer, and I want you to highlight this in your textbooks, is this correcting journal entry will take place on the 1st of the 1st, 20x9. Well done if you got it correct. Why is it happening on the 1st of January in the current year? Why is our journal entry happening on the first day of January in the current year? The reason for that is because we cannot go back into our previous year's general journal and post entries into a prior year. Okay, we can only post journal entries in the current year. So in order to correct our opening balances, well done, Donnie. In order to correct our opening balances, we have to post the journal on the first day of January 20X9. Please highlight that in your textbooks. You get a mark for remembering that you're correcting journal to correct your opening balances. We have to process the journal on the first of the first X9. Now, when I say correct your opening balances, let's look at the dates that have been given to us in this example. When was the machine purchased? The machine was purchased 20X7. So how many years have passed? What are our opening balances? The 20X7 year and the 20X8 year have passed. So 2 years have passed, which means that we have to correct our opening balances in respect of the 20X7 and the 20X8 year on the first day of January 20X9. Okay, so that's what I mean by we need to correct our opening balances. Let us look at now our journal entries. And I'm going to share with you a document which I've also emailed to you just before our meeting. Let me see if I can find it. Okay, so these are the scribbles that I would have made in our lecture today. So what I've done is I've started making the scribbles so that I could show it to you in our Zoom lecture this morning instead, because I can't write these up on the board. So step one then, here is step one. What is our error? We've debited our marketing expense and we credited bank or our payable. Now we're going to process our correction of error in respect of prior years. Very, very important. So we said that this journal is going to take place then on the 1st of the first month in 20X9. So that's the journal entry that we have to use there. Then we need to correct our journal entry. Instead of debiting a marketing expense, we need to debit machine, which is our asset, machine cost asset, and we need to credit our marketing expense. Okay, now you'll see I've got a little asterisk, a star next to this. Okay, can we credit an expense account that relates to 20X7? Can we credit a marketing expense account in 20X7? No, we can't. Well done. Well done. What do we use instead? Okay, the books have already closed. Well done. So we need to use retained earnings instead. So we know that it's in respect of the marketing expense. Well done, everyone. But we need to remember that now that we have a closed off these books, we can't use the marketing expense anymore. That would be incorrect. So instead, we would need to use, I'm going to abbreviate, please, you must not abbreviate in tests and exams. I'm going to credit retained earnings for $1 million. Okay, because we have a machine, we know that we have to calculate depreciation on this machine, and we need to work out what is the diminishing balance method of depreciation for 2 years. So we're looking at the X7 year and the X8 year. So if we take 1 million and we multiply that by 20%, that would give us 200,000 for the year X7. And in the year X8, if we subtract that 200,000 from 1 million, we get 800,000. Multiplied by 20%, that would give us 160,000. So the accumulated depreciation that we have to account for now at the beginning of the X9 year for the X7 and X8 year is 2 years of depreciation. Okay, 2 years of depreciation. So ordinarily, we would debit our depreciation and we would credit our accumulated depreciation. But we know from our first journal entry, we cannot debit depreciation. What do we debit instead? We can't debit depreciation. What do we debit instead? We're going to debit retained earnings. Okay, any questions up to this point? Well done, everyone. I'm glad you are interacting on the chat with me. I'm seeing all your answers come through, and I can see that you've pre-read and you've attended our lecture on Tuesday because you're all doing really well. Okay, any questions up to this point before we move on to the tax and the deferred tax? Okay, no questions. So let's move on then to our tax and our deferred tax. So we have to ask ourselves, what was the error here? If we look at the top of the slide, we need to understand what happened in 20X7. In 20X7, we had this R1 million, and that was expensed. And we know that expenses are closed off to profit and loss. So for tax purposes, then I'm talking about normal tax purposes, we know that the R1 million would have been expense and it would have reduced our profit. Okay, so if we think of what did our tax computation look like back then, it would have started off with our profit before tax. And our profit before tax would have been whatever amount it was. This amount would have been stated after subtracting our marketing fee. This is after subtracting our marketing fee. So this amount that we are showing the receiver of revenue here is actually understated. We've said to him our profit is this amount, but it's actually understated by R1 million. So in order to correct that, we now need to correct our tax and we need to increase our profit by R1 million. And we need to prepare a tax computation in order to do that. So the tax computation that we studied in first semester, we need to replace or redo that tax computation now. Okay, so what does our tax computation look like? So if I go back to my slide, I have prepared, all these slides will be uploaded onto Learn For You. I've done a tax computation for you. So if we start our profit before tax with this amount, we know that this amount was understated in a previous year. So to correct that, we now need to add back this marketing expense of R1 million. So what are we telling the receiver of revenue here? We are saying to the receiver of revenue, we are adding back this 1 million because in previous years, in 20x7, we understated our profit to the receiver of revenue. So to correct that, we have to add back 1 million to our tax comp. So we don't have a marketing expense. What do we have? We actually have an asset. We have a machine. And we know that for tax purposes, when we have a machine, we are allowed to claim a tax allowance on the machine. Okay. How much was the tax allowance that we were allowed for wear and tear? It was 20%. So we would be allowed to claim 20% of this 1 million as a wear and tear allowance for our prior years. So if we then go down on my tax comp, you will see that we have further down here, we have less wear and tear for the year X7 of 200,000, and we have less wear and tear for the X8 year of 200,000. So if we do our sums, if we're adding back 1 million and we're subtracting 400,000, what does that give us? It gives us a total increase in our taxable income of 600,000. A total increase in our taxable income of 600,000. So if we've got an increase in our taxable income of 600,000, do we owe them more or less tax? Do we now owe more or less tax? And how much is that tax that we owe more of? We were told our tax rate is 30% of 600,000. What would that be? 180,000. Well done. What is our journal entry then for this extra tax that we have to process? What would be our journal entry for this extra tax that we have to process? We would normally, after preparing a tax comp, debit our tax expense and we would credit our current tax payable for normal tax. That would be our normal journal entry. But you'll see I've striked off tax expense. And the reason for that is in prior years, this tax expense would have been closed off to retained earnings. So instead of debiting tax expense, we now debit retained earnings. Okay, how much? For the amount of 180,000, it's the increase in our taxable income multiplied by 30%. Well done, everyone. How did we arrive at 600,000? It was the adding back of our marketing expense, less 2 years of wear and tear. Why have we not also claimed the wear and tear for the X9 year as yet? Why have we not done that as yet? Remember, we are correcting our opening balances with this very first journal. So you need to ensure that you are only processing a journal entry for prior years. Well done, Staviso. Well done. Ayub, well done. So let's go back then to my very first slide, which was our journal entries that we were processing. And we corrected our error. That was the first journal we processed. We then did a catch up for 2 years of depreciation. And then now if you look down here, we have debited our tax expense and credited our current tax payable. If you scroll down on my slide, you'll see that wherever I've put a star in my journals, I've said here, we should not be debiting those accounts. Instead, that account should be retained earnings, because we cannot post journals to income and expense accounts that were closed off to profit and loss in our previous years. So wherever you see a little star, you know that that account should be a retained earnings. So I've got a question. Ma'am, are we saying that we've increased profits in X9 by 600,000 because in 20X7 we had understated? Yes, that is correct. Remember, I'm talking about taxable profits. So I'm looking at the tax effect. Okay, we claimed a marketing expense, which we didn't have. We didn't have a marketing expense, which means that we need to add back our marketing fee, and we take 2 years of wear and tear. So that 600,000 is an increase in our taxable income. Okay, another question I've got is, this means that in tests and exams we use retained earnings. You use retained earnings when you're doing retrospective restatement, when you are correcting your opening balances. That is when you use retained earnings. Okay, so that is current tax. So that was step 3. We're now going to move on to step 4, which is where we ask ourselves, well, what is the deferred tax impact going to be? Okay, and this is easy if you think of it in this way. You have to ask yourself, well, did I have deferred tax when I made the error? When I made the error, I had a marketing expense. So what would our deferred tax, what is the incorrect deferred tax that was sitting in our books? So if you go to the handout that I provided you with last week, you will see that I have provided you with in this handout with example 10. And if we look at this line item, the incorrect balance, this is when we had the marketing expense, okay? We would have had a 0 carrying amount and a 0 tax base, because at that point, we didn't recognize an asset. So our carrying amount would have been 0, our tax base would have been 0, therefore, deferred tax would have been 0. So now, in order to correct our balance, and I just want to add in here, and I want you to add this to your handout, is we are correcting here our opening balance. And you can also add in a date here on the 1st of the 1st X9, okay? So we want to know what was the opening balance at the beginning of the year. So the correct balance would have been, and there's a typo here, please change this to 1 million. It's missing a 0. 1 million less 200,000 of depreciation, less 160 of depreciation for X8 would then give you 640,000, which is your carrying amount. How did we work out our tax base? How did we work out our tax base? To work out our tax base, we would have taken 1 million minus 200,000 for X7, and we subtract 200,000 for X8, and that would have given us 600,000. Well done. Cost minus wear and tear. Well done. So now that we've got our correct balances, we can work out what is our temporary difference. Our carrying amount is greater than our tax base, which means that I will have a deferred tax liability. So 600 less your 640 should give you 40,000. If we multiply that by 30%, you've got 12,000, and that would be a deferred tax liability. Okay, now we need to compare two things. We're going to compare what is our incorrect balance versus what should our balance now be. And that's going to give us our journal entry. The incorrect balance was nil. The correct balance is 12,000. So we now need to increase our deferred tax. And when we increase our deferred tax liability, do we debit or credit our deferred tax account? We want to create a liability, a deferred tax liability. Do we debit or credit our deferred tax account? Yes, we credit our deferred tax account. What is the amount that we're going to use? We want to move from 0, which was incorrect, to 12,000. So we need to credit our deferred tax account with 12,000 Rand. Okay, what is the contra account that we're going to use? If we're crediting deferred tax liability, so if our journal is to credit our deferred tax liability with 12,000, what are we going to debit? Yes, we would usually debit our income tax expense, but because this relates to a correction for our prior years, X7 and X8, those accounts have been closed off. That tax expense account has been closed off to profit and loss, and then profit and loss account was closed off to retained earnings. So the correct answer here is we debit retained earnings for 12,000. Why not tax expense? Because our tax expense has been closed off to retained earnings in a prior year. Okay, any questions? Any questions? Let us look then at our journal entries. I will upload all of this to learn for you, so don't stress about taking it down. Rather listen and understand. Let's go back to our journal entries. So that was our current tax journal. Now we're going to look at, excuse me, we're now going to look at what is our deferred tax journal. We would usually debit our tax expense, but we're not going to do that because this should have been closed off to retained earnings. So we now can go to all our journals and strike off these accounts because these accounts have been closed off to retained earnings. So the only thing we can debit is our retained earnings. So now I want you to refer to your textbook and the solution in your textbook, and I'm going to show you exactly where we are. And what we have completed. So if you're looking at your textbook, what have we completed? Beg your pardon, I'm on the wrong page. Let's see if we can get this right now. Okay. So what have we completed then? We've completed the solution to 10A, but we've only corrected our opening balances on the first of the first X9. We've debited our machine cost. We've credited accumulated depreciation. our current tax liability for the extra tax that we owe. We've created a deferred tax liability of 12, and the contra account for all of these is retained earnings. So if you want to know what is the breakdown of these retained earnings, you can simply go to my slides and it'll break down each and every journal entry for you. You do not need to do your journal entries like this in a test or an exam or your tutorials. You can split them up individually into individual journal entries like I've done on my slides. Okay, any questions before we go to the current year? Any questions on the prior year journal entry that we've just processed? Notice that the narration here at the bottom says they've made the correction for the errors for X7 and X8. They have not as yet made the correction for the current year X9. So this only relates to the previous 2 years. Any questions? Please, you can always ask questions in the chat. Can I please repeat the current tax journal? You're confused with one, no problem. We can go there. So if we go to our current tax journal, so if we start off with our profit before tax, we need to add back a marketing expense of $1 million because we claimed it previously to the receiver of revenue. Our profit was understated by $1 million previously because we told him there was a marketing expense, when in fact there was no marketing expense. So to correct that now, we have to add back a marketing expense of $1 million. And instead of a marketing expense, what do we actually have? We have a machine on which we can now claim our wear and tear allowances. So if you scroll down under this add back, you'll see we are deducting wear and tear for 2 years. 200,000 is 20% of $1 million. For the X7 year, 20% for X8 year. And 1 million minus this 2 lots of 200,000 is going to give you 600,000. And that represents an increase to our taxable income of 600,000. And if we multiply that by 30%, we get 180,000. Shani Pile, are you happy? So the tax journal then would normally be to debit your tax expense and credit your current tax payable on your statement of financial position. But we can't do that because this relates to a previous year. We debit, instead of tax expense, we debit retained earnings. Okay, so that is our current tax comp. Okay, I've got a question, very good question. So if the error is immaterial and it is from a prior year, and then we don't need to use retained earnings. We only use retained earnings when it is material. No, you can use retained earnings even if the error is immaterial. Okay, the standard says to us when we have a prior period error that is immaterial, we can simply correct it in the current year if we want to do so. So that impact to retained earnings, we'll just process it in the current year. We don't have to go back into the previous years. So you can still use retained earnings. Remember, we must do as much as possible once we discover an error, whether it's material or immaterial. As accountants, we have to act ethically and we have to make sure that we correct our records, because all the information we provide is relied upon by the users of the financial statements. So we always have to try and do our best to correct our accounting records. Okay, let's move on to the current year now, which is much easier because we've done a lot of the workings already for the current year. Okay, so if we move on to the current year, so I'll just scroll down on my slides. I've repeated the journal entry for you here for the previous years. Now we're going to look at the current year. Now that we've brought the asset into our books, we can now claim depreciation for this 1 million rand worth machinery. And so in the current year, what you're going to see that's different now is because we are in the current year, look here, we are debiting depreciation, our expense. We are allowed to debit our expenses and income items now. Because we are in the current year and we're doing the current depreciation, we don't have to debit retained earnings. Because we are in the current year, this expense account has not been closed off yet. So we can make adjustments to depreciation. We debit depreciation, we credit accumulated depreciation. How did we get this value of 128? It's exactly the same workings as example 9 that we did on Tuesday. It would be the diminishing balance method at 20, and that is how we get 128,000. Okay, now we need to ask ourselves, okay, we've brought the asset into our books. We've provided for depreciation for the current year. Now in the current year, is there any tax impact still left over for the current year? So in the current year, we're going to ask ourselves, what is the tax impact going to be for this depreciation? So I'd like you to tell me, for current tax purposes, how is this going to impact my profit before tax? How is this going to impact my profit before tax? It's exactly like we learned in first semester. For tax purposes, if I ask you this question to make it easier for you, when we have a machine or an asset, any asset, what do we do on our tax comp? We always add back something and we less something else instead. What is that? When we have an asset, what do we do on our tax comp? We add back something and we less something else. What is that? Well done. We add back depreciation and we subtract wear and tear. So if we look at the slide that I've got on, we know our depreciation is 128, which we have to add back. How much is our wear and tear? It's 20% of 1 million, which is 200,000. So we're going to add back 128 and we're going to subtract wear and tear of 200,000. Add back your depreciation. So here I've got a tax comp for you. Okay, we've got profit before tax, and I've subtracted the wear and tear of 200,000. I'm getting a message that my internet connection is unstable. Can you please tell me if you can still hear me? Okay, great. Okay. If we multiply 200,000 by 30%, we get 60,000. Okay. Now, there's no depreciation on my slide. Why is there no depreciation on my slide? Let's think about it. In arriving at this profit, we have subtracted depreciation of 128,000. If I go below this then and add back 128,000, what have I done? I've done nothing, because this subtraction of 128 offsets this add back of 128. So the effect of depreciation on our tax comp is nothing. We've subtracted depreciation at arriving in our profit. If we add back depreciation, it's going to make no difference because it's just a subtract and an add back. That is why on my slide, you will see that I only have a deduction for wear and tear of 200,000. Okay, let's repeat that then. If we go to our profit before tax number, that's the starting point for our tax comp. In arriving at this profit before tax number, we would have subtracted depreciation of 128. Then when preparing our tax comp, we would add back depreciation of 128. So if we look at the effect of depreciation of our tax comp, if we're subtracting something and then we're adding it back, it's got nil effect on our tax comp whatsoever. So we don't even have to take the depreciation into account. What we do need to focus on is wear and tear, because remember previously the receiver of revenue didn't know that we had an asset. He thought we had a marketing expense. So now that we have an asset, we have to claim wear and tear of 1 million multiplied by 20%. That would give us 200,000. And if we multiply that by 30%, that would give us 60,000. What is our tax journal going to be for the 60,000? What do we debit and what do we credit? Can you tell me in the chat? What do we debit and what do we credit? Please tell me, what is our tax journal entry going to be for the 60,000? What is our tax journal going to be? We will, well done. Well done. We are debiting our current tax payable. Why do we debit our current tax payable liability? Because we're now claiming wear and tear that we never claimed before. It's got the effect of reducing our taxable income. If we reduce our taxable income, it means we owe less tax, which means that we can reduce our liability. So we will debit current tax payable and we will credit tax expense. Well done, everyone. Well done. You guys are doing very well. Debit current tax payable, credit tax expense. That's the current tax effect. So you can see in the current year, once we've done the catch up for the previous years, in the current year, everything is as normal. We prepare tax comp as normal as we usually did. So nothing has changed. So what is step 4 in our process then? What is step 4 in our process? We now need to look at what is the deferred tax effect. So I want you to go to the handout then that I've given you, and I want to take you to where we were previously first. Let me clear all my drawings first. And if we go previously, what did we do? We said we had no asset initially, so we had 0 deferred tax as a result. So nil deferred tax. Then we should have had a deferred tax liability of 12,000. So we debited retained earnings and we credited deferred tax liability. That's what we did to correct our opening balances. Now you see this line item here, our correction of our opening balance that we did on the first day of the first month, 20x9. This is now going to be our starting point for our deferred tax in the current year. Remember, deferred tax from first semester, we said we calculate deferred tax using the balance sheet method. So because we're using the balance sheet method, this would be the balance at the beginning of the year on the first day of the first month, X9. So this 12,000 is going to be our starting point for deferred tax. Now that we are in the current year, you can just scroll down. We go into the current year, and you will see our starting point now is what we have done with our first journal entry. Here's our 12,000 deferred tax liability that we've created. Now the X9 year has passed, so our carrying amount and our tax base will change. In our carrying amount, you'll see here is an additional year of depreciation of 128. So from 640,000, we subtracted 128. That gave us a carrying amount of 512. And in our tax base column, we did have at the beginning of the year 600,000. Now we claim an additional 200,000 of wear and tear, and that brings us down to a tax base of 400,000. 400 subtract 512 will give us 112. That, if we multiply by 30%, we'll see we need a greater deferred tax liability of 33,600. What do we have in our journal currently? We have 12,000. So we need to increase our deferred tax liability to a value of 33,600. How do we do that? We credit deferred tax and we debit the tax expense with the difference between these two amounts. And that amount is 21,600. So if we look at our completed journal now, if you look at your textbook, and if we look and we focus now on the current year, here's our depreciation of 128. Here is our reduction of our current tax payable. And here is the increase in our deferred tax liability. Okay. The contra account for those tax entries is 38,400. And those can now be processed to our income tax expense because this account has not been closed off to retained earnings. We're in the current year, so we can process journal entries to our expense and income accounts. This example was an example of where prior tax assessments are reopened. At the beginning of the current year, we could adjust our current tax payable because the receiver of revenue said, yes, you can go back to your tax assessments and claim the wear and tear that you previously did not claim, and you can add back that marketing fee. Okay, this is example 10A. We're now going to move on to example 10B, where the receiver of revenue says, no, you cannot open your prior tax assessments. You need to now make all your adjustments in the current year. So what impact is that going to have on the journals that I have here on my screen? Okay, so if you are following with me on your textbook, we are in example 10A on page 1222. And if you look across the page at page 1223, you will look at both sets of journal entries opposite each other. And you can compare and see, well, what is missing now? If the receiver of revenue tells us, no, our prior year assessments are not reopened, what is missing from the first journal entry? Okay. Can you tell me what is missing? This is missing. Current tax payable for 180,000. That is missing. I'm now looking at the solution for 10B. That line item is missing. And the reason for that is the receiver of revenue is going to say, I'm not going to allow you to reopen your tax assessments. That means that at the beginning of the year, on the first day of the first month, we are not able to correct our current tax payable liability. The receiver of revenue says, no, that's too much of work. I'm not going to go back and open up your previous assessments. If you want to make any adjustments, you need to make them all here at the end of the current year. When you submit your current year tax return, this is where you're going to make all your adjustments in the current year. Okay, and that's basically the difference between example 10A and 10B. There's one other difference if you compare the solution for 10A and 10B. What is the other difference in 10A and 10B? This is the other difference. The deferred tax amount is different. In 10A, the amount is 12,000, and we know how to calculate 12,000. But in 10B, the amount is 192,000. Okay, so why does that happen? That happens because the receiver of revenue says, I'm not going to allow you to go back into the prior year tax assessments and make your adjustments. And that's going to give rise to a timing difference. Instead of correcting our opening balances at the beginning of the year, we're now going to correct it only at the end of the year. So we're going to have a timing difference for just 1 year. And therefore, you'll see in example 10B, your deferred tax amount is different. So I wanted to bring the differences to your attention before we even attempt the example. I know our lecture's over. If you do have another lecture to go to, you're welcome to leave. I am recording, and I will go through example 10B, and you can always come back to this example. I'm going to move on now to example 10B. And in example 10B, we now have the situation of not being able to reopen our tax assessments. So our starting point is going to be the same. We're still going to have no balances for the carrying amount in tax base. Why? Because at this point in time, we had a marketing expense. There was no asset here. That was the error that we had. In order to correct that, then, we now need to look at, well, what is our deferred tax correct balance? What should it be at the end of the X8 year on the first day of the first month of 20X9? So on the first day of the first month, 20X9, at the beginning of the year, how are we going to correct our balances? We'll take 1 million of our asset and we'll subtract depreciation of 200,000 and 160,000 for the year X8. But very important, I want you to look at our tax base column. Notice now it's null. Why is it null? The reason why it is null. Why null? Because we cannot, beg your pardon for my spelling, because we cannot open our tax assessment now. We can't open our tax assessment to correct the claim wear and tear, because the receiver of revenue says, no, you can't go back in the past. And therefore, we've got a null tax base. That's going to give us, well, what's that going to result in? It's going to result in a huge temporary difference, and it's going to give us a large deferred tax liability that we have to account for. And the reason for that is because we cannot open our tax assessments to correctly claim the wear and tear for X7 and X8. So the journal entry then that we process for deferred tax will be to debit retained earnings and credit deferred tax with 192,000. So if you refer to your textbook then, your textbook, if I could just clear my drawings and scroll down to example 10B for you. Here you will see our deferred tax is being credited with 192,000. Okay, 192,000. Why? Because we could not open our current tax assessments and claim our wear and tear for the previous 2 years. Everything else is exactly the same as example 10A. Let's look at what then happens at the end of the year. Now, when we come to the end of the year, the journal entries we're going to process is on the last day of the year, the 31st of the 12th, 20X9. We now can prepare a journal entry for the depreciation and accumulated depreciation. And now that we've come to the end of the current year, we've calculated our depreciation. The receiver of revenue says you can now make all your adjustments for this error in the current year. You can't go back to previous tax assessments, but when you are submitting your tax assessment for the current year, you can claim all the wear and tear you would have claimed for the last 3 years. So you'll see in the workings in your textbook, there's the 1 million add back of the marketing expense. Please write that down in your textbooks. This 1 million is the add back of your marketing expense. And then you'll see there's a subtraction of 200,000 multiplied by 3 years. That is for the X7, the X8, and the X9 year. You can see all the wear and tear is now being caught up with in the current year's tax return. So 200,000 multiplied by 3 years, that would give you 400,000. And if you multiply that by 30%, you will see that we now owe SARS an additional 120,000. Okay, any questions up to this point before we look at deferred tax? Okay, we've just got 5 minutes left. I'm going to go through the deferred tax with you. And we're going to look at, well, what is the deferred tax workings now that we've reached the end of the year? When we are calculating deferred tax, remember we use the balance sheet method. So the 192 that we did, we processed a journal for at the beginning of the year is going to now be our opening deferred tax balance in our calculation for the end of the year. So this line item is now going to be our opening balance for deferred tax when we do our calculation now. So if you scroll down on the handout that I provided you with, you will see our opening balance now is the 192,000 deferred tax liability that we processed. Okay, let's look at each column. What should our carrying amount be? For depreciation, we had the asset. We subtracted 200 for X7, 160 for X8, and 128,000 now for the current year. That gives us a carrying amount of 512. Very important now at the end of the year is to notice that previously we had a nil tax base. Why? Because the receiver of revenue did not allow us to claim our wear and tear. Now we have a tax base of 400,000. How did we get a tax base of 400,000? That would be 1 million, which is the value of our asset. And if we subtract 3 years of 200,000 worth of wear and tear, that is the tax base of 400,000 that we now have. That is how we arrive at our tax base. That would give us a lower temporary difference and a much lower deferred tax liability now of 33,600. So we need to now reduce our deferred tax from 190 to down to 33,600. If we are reducing a liability, what do we do to that liability? We will debit the liability for the difference between 192 and 33,600, and that amounts to 158,400. So we need to prepare a journal entry then, and our journal entry would be to debit the deferred tax liability and to credit the tax expense for 158,400. Okay. Any questions before we move on to my last slide? Any questions? Please raise your questions in the chat. Okay, we then move on to my last slide, and I want you to turn to example 12 in your textbook. Example 12 is the same example as 10A. I just want to highlight for you what you need to look out for in example 12. So on my PowerPoint slides, you'll see I've put notes for you as to what you need to remember for disclosure purposes. If we go to example 12 then and have a look, I'm going to tell you exactly what you need to highlight in your textbooks. For example 12. Remember I said to you example 12 is exactly the same as example 10A. So you've been given your draft statement of financial position, statement of comprehensive income, and you're asked to prepare the notes and the statement of changes in equity, as well as your statement of financial position. So this is all the information that's given to you. Right, this is what I want you to highlight in your textbooks, please. Number one is I want you to notice there are 2 years of comparatives. Okay, 2 years of comparatives. The error occurred in the 20X7 year. So that is the year that we have to disclose. And notice it has the words restated at the top. This is important because you get a disclosure mark, number one, for showing the correct comparatives, and number two, for having the words restated, because you're telling the users of financial statements, if you pick up the 20X7 or 28 set of financial statements, they're not going to agree to these 2 columns that we have. And then you need to give them the reasons why in the notes to your financial statements. So as soon as the users see these words restated, they will go to the notes to your financial statements for an explanation as to what has been restated. The third thing I want you to note on your statement of comprehensive income is if you look at your workings are always accumulative. So you'll see in the first year, it was 1 million less 200,000. That would give us 800,000. Notice then in the next year, the balance starts with 800,000. So it's cumulative. 800,000 minus 160 will give you 640. Notice in the last year, then our workings start with 640. So your balance sheet, because we take on our opening balances in the next year, our balances get carried forward for all our asset, liability, and equity type accounts. The same applies to retained earnings, deferred tax, and current tax payable. Let's scroll down further and look at the disclosure then on our statement of comprehensive income. There's 1 year of comparatives for a statement of comprehensive income. Here again, we have the words restated. Okay. The workings, however, are not cumulative. Because we close off our profit and loss to retained earnings every year, you'll only see 1 year of adjustments here on your statement of comprehensive income. If we go down further now and look at your statement of changes in equity, I did this in detail with you on Tuesday, so I don't want to repeat it, but I want you to highlight, first of all, there's 2 years of information here. It's the X8 year and then the X9 year. So when preparing your statement of changes in equity, remember there is 1 year of comparative. Then you'll see the words restated along with 2 extra line items as previously reported. So if they pick up the previous year's financial statements, they will see this is the amount that we had previously. What has changed? We've corrected a material error here of 560. Then our closing balance will also have the word restated, and our balance at the beginning of the year is restated as previously reported, and the correction of material error once again. Okay, very, very important are these wordings, because these carry marks. They are disclosure marks. Okay, so don't forget those line items. And then finally is the correction of error note. We went through this on Tuesday in example 11. The first part of the note is a narrative. Notice for the effect on the comprehensive income, we have a single year of 20x8. And the signage, the increase, decrease, and increase, decrease here. Notice the difference in signage. Okay. And then further down, if we look at the effect on the statement of financial position, increase, decrease in assets is different signage to the increase, decrease in liabilities and equity. I illustrated this on the board for you on Tuesday with the ledger accounts and the signage. This is something you are going to have to learn. And lastly, I want you to look at the bottom of your effect on the statement of financial position. You've got 0. So all your adjustments, 180, the 640, minus the 12, minus the 448, should get you down to a value of 0. That is how you know that you have done the note correctly. If you don't get down to 0, it can mean one of 2 things. Number 1, your signage is incorrect, or number 2, one of your amounts is incorrect. So you can backtrack and check your work if you don't come down to a value of 0. Okay, I'm going to end the lecture there, and I'm going to leave the chat open. So if you have any questions, please ask me your questions in the chat. Thank you, everyone. Have a great weekend.